Good evening, everybody. I hope you're well, and welcome to tonight's Inner Circle session. It's all about exits. Great that you can hear me. David, welcome again. Good to see you here. Yes, my daughter has actually told me about the lunar eclipse tonight, and we're going to have, no, at this stage, the clouds are letting us see the moon in its full glory, or what's left of it. So I think a couple of hours and it really kicks in. But it's started now, I believe. So some interesting things to have a look at, and the fact that my daughter told me is also encouraging, because she's keeping her be abreast of other things apart from trading, which is never a bad thing. So as I said, we're all about exits tonight, and great that so many of you are here. Hi Stephen, good to see you here, buddy. Just put up this important message, of course. I'm going to express opinions tonight and my view of the market. We are going to have a look at the market live as well, of course. So please just be aware that this is my opinion only, not representative of gold markets, but is for educational purposes only. So please bear that in mind. Nothing that you see or hear should be taken as direct advice to take trading action. So you've got to make your own decisions, do your own due diligence, follow your plans, etc., etc. All important stuff, but let's get into it without further ado. Hey Rachel, how are you? Hi Ewan, good to see you here. Shane. Good stuff. Okay, so let's have a look across the market, see what's happening. So just a bit of news. Obviously, we had a positive session in the US last night, and we've had a little bit of follow through. Sorry, we had a neutral session. In fact, slightly negative it closed. The Nasdaq was actually neutral. The Dow was about down a mere 2.2%, likewise as the S&P 500. But we've had positive futures really since almost immediately after market open today in Asia, and so we had some follow through in Asia. A bit of a mixed session going on in Europe. Asia finished positive across the board, with the exception of the ASX, which finished 0.3 down. In Europe, the CAC 40 is up, but the FTSE and the DAX are both down very, very slightly. And bear in mind, of course, that they were expected to be down, because at the time the markets closed yesterday in Europe, the S&P 500 dropped off from there. So we were expecting a little bit of a down day. So the fact that they're nearly neutral is actually quite positive. Good evening, Ian. In terms of economic data today, there's very little. There's nothing going on at all, really. So there was an RBA, an NZBA, I think they call them, or the Reserve Bank of New Zealand, RBNZ. That's it. They had their interest rate decision, but also the policy statement. So we'll just have a look at and see what's happening on some charts and some stuff. So there's the futures contract. Russell's outperforming. Nasdaq's probably slightly off its earlier high, but you can see how well the Kiwis performed against virtually every other currency. Yen's weaker, so we'll have a look at Kiwi yen in a moment. We can see the VIX has dropped. We can see some fairly neutral stuff going on with oil, and gold and silver are both up on the back of that US dollar weakness we saw yesterday, although the USD's index is slightly higher due to its performance against the yen and a little bit of the euro, which has been very strong lately. But that 1900 level on gold is really important. You can see copper starting to move up again. Hi, Ross. Hope you're well, mate. As I said, nothing in terms of economic data of any interest. One of the Fed, there's going to be much there. In terms of tomorrow, we've got some consumer confidence numbers coming out of Germany, but really it's the weekly jobs and GDP numbers coming out of the US. So just watch yourselves tomorrow evening, particularly if you're having a 15-minute chat. So you can see really this has got quite choppy, really since European Open. It started off down here in Asian trading, moved higher, was pretty neutral until European markets opened. It's chopped around like a mad thing in quite a wide range, but without dropping significantly. So still up on the session, as we said. In terms of where that sits, it sits quite positively actually, because we had this breakthrough what could be an important level, probably not drawn that the best, around about this 13,620 level. So that was yesterday's trading, almost neutral, and then, as I said, we're up today. Just watch this level at 13,750. If we break through that, we could be tackling record highs again in the not too distant future. I just get the feeling that markets are climbing slowly but surely, almost crawling upwards, in the absence of any bond yield increases. Markets are feeling pretty good. You can see that where the VIX is. Oops, we don't want a new order on that. We want to put candles on that. That's what we wanted to do. Here's the S&P 500. So you can see we had that double bottom completed. There's the breakthrough. We had a 1 day last night where it was down slightly, but we reversed that essentially in today's futures contracts. The record highs are a stone's throw away from where we are now. And this is why I say we're in quite a good place. That's only 0.5% up from where the futures are now. That's nothing. That can be done in a heartbeat. And so if that jobs number comes in well tomorrow and the GDP number looks okay without being too hot, we'd expect a challenge of that. But that is an if, of course. Here's the US dollar daily, and you can see that's trying to hold on to support around this 1970 level, so 89.70 level, just below that 90, but still in this downwards trend channel that it's been in for a while. It just is looking a little bit like a descending triangle here. So is there enough momentum to take it through this or not? And much may depend on what equity markets do over the next couple of days. Consequently, well, let's just quickly have a look. Copper's bouncing around a little bit as well. We can see this pullback here. We've found an established support at around about at that 450 level, which was the key level or the key high in 2011, so decade highs. So we pulled back from there, not surprisingly, after this major run up that we've had. So we're just waiting to see if there's going to be a bounce in that. There's a potential accumulation from a fundamental point of view that I'm playing with at the moment on that. If we look at the VIX, you can see how comfortable the market is. It's drifted back down. This is obviously a longer term contract than the one you see on FinViz. So you can see how this is down near 1864. So that's really a reflection. That's the first interest rate drop. Sorry, interest rate rise or bond yield rate rise. That's the second one that we're concerned about last week. But you can see how we're just drifting down nicely to say that market's okay. Now, the problem is certainly in the FX market, it's very difficult to trade those long term simply because everything's in trading within a range. There are a couple of exceptions which I'll have a look at. So we'll start by looking at the Euro USD. Now, note this line here at 122.40. We'll put that on a daily chart and you can see why that's important. It was a high here. We played with it back in December and we got stuck here. Over the last few days, we've really got stuck in between these 2 points. And this is what's happening in FX markets. Makes it really difficult to pick a daily trade. So 63 pips in between top and bottom, and really a failure to break through on several occasions now. So the market's in, we're not sure about this sort of mode with that. Look at US yen, exactly the same position. We've got a very established support in at 108.50. I just want to point you in the direction of these ATRs. Look at the ATR, even the 6 ATR on this. Just see how low that is. If we just pop that back to the Euro USD again, you can see how volatility has dropped right off. Euro New Zealand dollar. Now, there's been some movement in the Kiwi today. So here, and we saw that across the board. So if we, there's the Euro Kiwi. So that is in a range, but you can see that big bar today on the back of the policy statement that came out with that interest rate decision, which was a no move. But if we look at, I was actually in this. Those of you who sort of hear me elsewhere will have noticed that I put in a sort of chart of, in fact, this is my chart of the day today. So we can see here that we've got that breakthrough, that 79.27. Now we know it's not the yen, because if we look at GB pound, which is also in a really awful place in terms of direction. So look at, you can see it's not, if we put it on the daily chart, it's not to do with the yen. It's all to do with the Kiwi. So if we look at GB pound Kiwi, you can see there's a big move there, taking it down to the 200 MA. That's interesting for sure. So it is Kiwi strength rather than weakness in any other specific currency, because we're not seeing any move in any other specific currency. We saw a little bit of action in the Aussie as well. You can see that was sort of dragged down along with the Kiwi. So not a dissimilar chart there, certainly not the same sort of bounce, but undoubtedly looks as though over the last few hours it's trying to find a bottom. So there's the GB pound yen going nowhere. The market is lots of wicks kicking around there, but very, very little price movement at all, even though we're kissing resistance. So we've got a picture there where we got some news out of New Zealand, which moved markets in that specific currency. So, and the Aussie backed up on the back of that, as those two often move in the same direction. If we look at Kiwi Aussie, Aussie Kiwi, we'll put that on there, and you can see the Aussie underperformed. So it was actually Kiwi strength rather than Aussie strength in equal proportions. But you can see we're back down to a key level on the Aussie Kiwi even, down at 106.43. So is there any more upside? We like the Kiwi yen as the trade, but you can see there, if we look at the 5-minute chart, we've just, actually let's look at the 30-minute chart, let's not get carried away. So we had that pop up, we had that sideways trend, but what do we see now? We see it challenging that next level up at 79.60. So we can see that high on the daily chart. How high can it go? Well, we can go about months, and we're not going to see it this high since May 2007. So long term, possibly move up to there, but that's like 300 pips away, so we'll not be worrying about that for right now. But just for context, but we see now we've got that break. We take it to a shorter term time frame, and you can see it's giving it a crack. Okay, so see where this sits in 15 minutes or so, and that might give you an indication as to whether there's any further potential upside in this. So this is about the only currency that's showing any degree of action at all, and how long that lasts is up for debate, really. Okay. Elsewhere, on the share CFD side of things, there are a couple that caught our eye. Wesfarmers caught our eye because of this big jump, but we've got a sort of line in the sand there. The ASX 200, you can see, it's still trading within a range, albeit to the top of that range. There's that 7100 level that looks important now on the market. We did actually test that in early trading, but then closed, as you see, closed lower than our open. A couple that were jumping today. Xero, we've got an eye on because we went for it to break through 128. We'll check in on that tomorrow. And the one we referenced yesterday was TWE. So closed up but paused a little bit today, but look very set. So we could have, we're actually in this one, I'll show you, because I believe in keeping it real. So there's the entry today. So we're up a little bit on that from yesterday's trading, but a doji type candle today. So we're a bit cautious about this, but if it does, if we do get any follow through, then that's the level there, around about 3% up. In the US, we like PayPal at this level where it's at now. So we're looking to see if it's going to break through that at 259. So that again is one to watch. And the other one that caught our eye was Twitter, which I've traded in and out of a few times now. This is important because it's broken through the 200 MA. That would have been a potential entry there. But we've also seen that this has been a key level. This gap here is just crying out to be filled. That was 2 days ago. That was yesterday's neutral trade. So we're looking for any move higher, and there's quite an upside on this if we do get some follow through on this of around about 10%. So that's one to watch in the US for those of you trading US share CFDs. All good. Oh, by the way, don't miss, while I just remembered, if we look, if you're not in this, and you've not done share CFDs, I'm going to send you a link here. And rock up on Thursday, and you can learn some more stuff about how it works. I'm just going to put it into chat. So that's Thursday at 8 o'clock. There we go. Sent. It's in chat, so you can register for that as you so desire. Okay, so that's really what the market is in terms of where it is now. As I said, I'm sort of seeing an absence of any major headwinds in the very short term, but just watch for that data on tomorrow. That could be important. If that comes in at or slightly better than expectations, then I would expect to see markets continue to climb. Right. Okay, so what I'm going to do with this exit stuff is I'm going to go back to basics. I'm going to go back because I keep on being asked questions that suggest that some of you are perhaps less experienced, haven't quite got it yet. I'm also going to talk a little bit about the psychology of exits as well, and why some people do and don't, even if they've got a trading plan that's written. So I'm also going to talk about two associated exit approaches, and then talk a little bit about planning, and then, as I said, the psychology of exits. So just back to here, this is all in your head, okay? So even with exits, we're interpreting what's happening in the market and what's happening on the price chart, and then we should have systems that guide our every decision based on that, and so we can make a decision by combining those two, taking appropriate action and follow through to then create our results. Why is exits important? Well, essentially, you've got to have these three critical components in place to develop or to have an exit strategy which is going to work at its optimal level for you as an individual trader. Because I can give you an exit plan and it might work or it might not work for you, but as I've said before, the critical thing is that you develop something that works for you. We all look at the markets differently. We all look at the markets different times. We trade different instruments, trade different time frames. So you've got to find something which is right for you. So you need that exit strategy to cover all market situations. You need to obviously follow through on that and execute it, have the discipline to and confidence in it to make it happen. And then, of course, you need to measure it through a journal. And that isn't too bad. That's 18 minutes to mention journaling, to be able to refine it and better fit your trading style. Obviously, we look at the parameters we're using. We'll look at the systems we're using and decide, well, does that fit for us, or do we need to tweak them a bit? So we can, once we've got a critical mass of trades, we can test against them and, of course, then feed it back into our strategy. Tale of two traders, just to reinforce the key points. This looks very good for trader one and very bad for trader two, but it's not just about win-loss ratio. It's about keeping your losses small and let your profits run. So look at trader one results. Even though it went in their direction 4 times, we let ourselves down on exits here, and so end up with a minus figure. And with trader two, we kept a loss small every single time, let our profits run on these, which are all to do with exits as well. And of course, we ended up in a positive territory. So there's a couple of ways we can do this. We can sort of do the we can do it sort of look to increase our win-loss ratio and keep our average win, average loss around the same, or we can look to increase our win-loss ratio, keep our win-loss ratio the same, and subsequently, of course, improve our average win versus average loss, and I'll show you that in a second. There are 4 key exit approaches we can use. and we'll go through these in turn. I just want to quickly look at something just to show you what I mean. Give me a second. Let's say 6 months. Okay. Just setting something up for you here. Okay, so and let me show you what I mean here. So actually, I'll show you how I do it. It'll be far more useful. Okay, so I'm going to show you something how to get those key figures, because they are important, because you use those as a benchmark. Okay, so you go into history, and then you right click, and you can choose a custom period, or do the last 3 months or the last month. So what we're going to do is we're going to do the last 6 months. Okay, there we go. Okay, and we click on OK. And then what we do is we create a report. So we right click on this report, and we can open that, and it'll create this report, which will list all the trades that we've done in that time period that you specify. And then if you go down through all the trades, then ultimately you come up with the bottom line data. Eventually, you can see this is a lot of trades on this account. There we go, that's what we're after. Okay, so the last 6 months, you can see this was an insertion of 10 grand at this point here. So you can see there what the account value actually is, the equity curve on that. So a couple of blips in the road, big blip there, not very nice. That was when the got caught on the interest rate on the bond yield spike, and I just happened to be long several trades at that time, just because I didn't keep an eye on it. But these are the important figures. Okay, so you essentially your profitable trades. So 68% profitable, 31% a loss. So that's a good win-loss ratio. And what we've done, we've got a slightly bigger loss over the last couple of trades. We've got a trade that really clobbered us in that period there. That's that trade there. But you can see these aren't too bad. They aren't too far away. If I put that on a longer time frame, that would almost be identical. And so you can look at this and say, well, what do I need to work on? And I just need to be careful with this sort of stuff. That really caught me out, that trade. But there's been a couple like that, and sometimes it'll happen. But that's how you get those figures. So you work on win-loss ratio, and you work on average win, average loss. Okay, so that's really where you need to be, okay? Because the reality is, if you look after those numbers, then this will look after itself, okay? And you're going to have these times. That was a really rough ride this week. I have to say that this week has been really difficult to do well on, but ultimately, if you look at sort of from where this was, which was, I think that's the last month and a half. Okay, so a really good 3 or 4 weeks there, where trades just seem to go with you, but that's not your norm. Okay, because you're going to get periods like this. Okay, up, down, very little progress. And then sometimes it's going to do this. So if you keep on doing the right sort of things with the right exits, it's going to follow, okay? Right, okay. That all being said, so how do we get to that place where we got these 4 primary key exits approaches, the initial stop, trail stop, and profit target, which are all about profit protection, and in the event stop? I'm not really talking about that, because that's really when, if you have a strategy that says when there's a piece of economic data, I'm going to get out of here before it's announced. You can do that for sure. Most people would prefer to trail a stop accordingly, maybe tighten it up a little bit. Now, the situation where you might do that is when there's other stuff going on in your world, which means you should be out of the market. You should be focusing on those other things and making them happen. And then there's two secondary, that should be exit approaches. Apologies for that. Let's just scrub that out and put exit approaches. Okay, and writing with a mouse is really hard. Sorry, writing with a mouse pad is really hard. There we go. Okay, job done. So that's where we're at. So we're going to go through these three, and then I'm going to briefly mention these two because they are important. I haven't really covered those before this in any sort of detail. So, okay, so let's look at the common ones. I'm going to whiz through these pretty quickly because they are pretty straightforward, and you'll all know about them. It's just a case of, are you actually doing it? Have you got it written in your plan? What parameters are you using? That's really where I want you to be at the end of this session. So obviously a stop loss, you're capping a loss at a particular level, which alongside position sizing determines your risk per trade. And you should really set your stop loss and then position size accordingly based on how much you're prepared to risk. And we've talked about before about position sizing in different market conditions. So you enter a breakout of a resistance level, price falls back into the sideways trend. So logically, you're setting a level below the original resistance. I don't know what that sentence means there. Missed something out, it looks like. Or you enter on a cross, and then your initial stop is the price crossing over the 200 MA. So the challenge is with this is how to get consistency in action. So a couple of things that we've suggested is, well, look, let's say we entered on this breakout here. Maybe I better do FX. I know. Okay, let's look at this. Okay, let's pretend we're interested in this trade here. Okay, on 30-minute chart, it is almost 30 minutes. Okay, so let's say we're interested in this. It's not quite a good breakout yet. If we were to put the ATR on this, and let's put the 6 on it because it's had obviously quite a big lump up in the last 14. So let's put the 6 on it. So we've got 9 pips, let's say 10 pips. So we'd want it 5 pips above this signal line here. Okay, we can see the signal line because we put it on a line chart. Let's kiss that a few times. Okay, so really we're not entering this until it's at 79.58 plus 10. Oh, sorry, plus half an ATR, so plus 5. So we'd be at 79.63 is the entry. So it doesn't look as though we're going to enter it unless there's a little pop-up in the next 2 minutes. So that's not going to meet our entry criteria. And indeed, we've got a decrease in volume as well. So cross all the way along. Okay. Let's just look at, maybe just have a quick look at the GB pound. Nope, not going down. Euro. Oh, okay. So let's say we're interested in this one, okay? Because that's nearly a 30-minute short, okay? ATR is 18 pips. Okay, so it's got to be 9 pips below. So we want, there's our signal line to 167.46. It's trading at 167.50. Oh, sorry, 167.40. So we are not 9 pips below that. 167.37 is our actual entry. So we'll put that on there. And we're going to make it green, okay. Actually, green. Okay, so that's our entry. Is it going to close below that? Well, no, it hasn't. So we've got to leave it. Lower volume anyway. But let's say we entered it, okay? Let's say we entered it. So we've got a choice. How do we make this consistent? So we make it consistent by having something that we can use on a regular basis, irrespective of time frame or instrument or pricing. Okay, so we could use the ATR. So if we sort of say, well, look, we've got an ATR here of 17 pips. That means if we're going to use a stop 1.5, let's call it 18 because it makes the math easier. We make it 1.5 ATR below our entry signal, that will be 18 pips plus 9 is 27, so 27 pips above this. So 127.73, 167.73 would be where it's at. So that is where our stop is. Okay, let's make that red, or maybe orange or something, just to sort of differentiate it. So we now have a system that we're going to use for every exit. Okay, so if we use, now it's your call whether you use it 1.5 ATR below your signal line or 1.5 ATR below your entry. You plant your flag and then you test the alternative later on when you've got a critical mass of trades. But that's what I mean about consistency in action. Okay, stop loss covered. Profit target, same deal. We're setting a price target that says this is where we think it might stop, usually based on a previous key price level. So if we're doing that short trade, we might say, well, look, we want the next support. And of course, we can pre-program on our trading platform. So how do we get consistency in action? Well, we could sort of use our ATR again. I'm just going to take it right out because we're going to have to hunt around, I think. Okay, so let's say that we identify our next key level there. Okay, so that we think that the support could be there. Okay, so this is for our profit target. So we can skip it back up now, put it back on the candles. There we go. And we're going to do that. Okay, so we're 18. So we're going to do it 9 pips above this. So we're going to make our profit target at 166.90 plus 9, 166.81. Sometimes it's easy to do this. Okay, so what we've got is a risk level here of entry if it triggers at 38 pips. So position size accordingly, and we've got a potential profit target of 56 pips, so about 1.5 reward to risk ratio if we're setting a profit target. Okay. And some people would prefer to do that. If not during the session they're looking at, then some people prefer to do that if they're going to sleep and as an overnight thing. Then we of course move on to trading stops. What we're trying to do here is lock in profit. So managing profit risk so we don't give it all back again if we enter. So the idea is we trail, and then ultimately it's triggered. Now on this, we've used retracements, price retracements as a signal to trail. That's one method. We're never going to pick or we're rarely going to pick the top of the market. Invariably, our profit target will do that. The reason, just to answer a question, the reason we put our price actually below that or above, in the case we looked at above the support, is that there's going to be a lot of buy limit orders there, which are going to be counting on the bounce off that support. So a lot of those are in place. So it's got to have some momentum to sort of push it on through that support level. So we have it just above there, just to sort of lock it in. And then we can see what happens next and potentially get back in. You've got notifications set up on your phone, which most of you will have. Then you can know it's been triggered, and then have a look at a chart an hour later and see what's happening. Has it actually broken through? In which case, you start a new trade. Is it a bounce? Does it fit our bounce strategy? Then, of course, we can trade it the other way. Okay, back to trailing stops. So the key question is how you get consistency in action. And of course, we've got a number of different options. We can use a price crossing the short-term EMA. That's probably the most common, or a technical landmark. So we can use a pivot low or a fractal on a retracement. So let me just find one that we can try this on. This doesn't really work because you were in, if you're lucky, early on. Maybe this one, if you're very lucky and you just saw it happening. Let's look at likewise with this. You could have got in on that one there, but and been in a good place. Let's actually. That would certainly be okay. Okay, so let's use this. Okay, so let's say we're in the Euro Aussie on a 30-minute chart on this candle here. Okay, and we set our initial stop here. Okay, so 15 pips above it would be, so possibly a little lower than that. Yeah, about there-ish. Excuse me. Okay, so we're in here now. If we're using the 20 EMA, let's put it on an hourly chart. No, let's not. Let's put it on a 30-minute chart. Okay, if we're using the 20 EMA, then what that means is on this candle here, we move it down to there. Okay, on this candle here, we move it down to there. Now, if you get this break here, you can see the profit risk associated with this, because if that's where our stop is now, that's 29 pips. And remember, our initial risk was 14 or 15. So it's almost 2 times our initial risk. So at this stage, I would be using the 10 EMA now. Okay, so as it moves down, each candle, next candle, next candle, next candle. So we're down here somewhere now, and you can see that 10 EMA, and ultimately it probably triggered, if not on that one, then certainly on that candle there. Okay, so we've locked in a nice 39 pips. Now, it could go on and carry on, but of course, it might not. It might just do this for the rest of the night, or it might sort of bounce off here and go whoosh and back up there again. So that's why we trail our stop. We want to lock this in. Now, the other method we can use is retracements. Now, there isn't much chance here with retracements, but what we might do is we might have it. So let's say we started here on this little pause here. I would certainly be moving it halfway. Then we had a little retracement here. You'd certainly be moving it down to there. Move down again. So you might even be moving it. You might even be still in this and possibly move it down to there right now. So that's a retracement. So every time there's a little pullback or a little pause, you'd be moving it downwards. That's a retracement method. The other method I'm going to tell you about in a moment is this MACD signal line. So you can see here, the MACD signal line has crossed below the histogram. So this is the histogram is merely a reflection of the distance between these two moving averages. So you can see it's coming in, and there's a moving average of this histogram, of the difference between those two moving averages. And so at that point there, the signal line is lower. So we're going to get out on this candle here and lock in our 40 pip profit. Okay, so those are the 3 most common methods that we use if we're going to get consistency. Okay, now what I'm going to reinforce is that you need a safety net stop if you are using the MACD, because you could have a candle like we saw with the Kiwi. Imagine you are long this trade. You could have that sort of position going on, and your MACD wouldn't have a chance to respond. So you should always have a safety net stop in somewhere where you think might be appropriate. Again, you can you might do it every time. Every time there's more than a 2 times risk gap, you might move it back down to 1 times risk. Okay. The other thing we can use is an ATR level, and we usually remember we've used our a risk level. So remember, we've based our initial stop on 1.5 times below our signal line. So if you want to, you can keep it every time it moves up 1.5 ATR. We're going to trail it up. We're going to trail it up, trail it up. You could even make it 1 ATR if you want. So once it gets to 2 times ATR, so in this case it was 10 pips, I think. So once it gets to 18 pips. So once it gets to 18 pips profit, we're going to move it to break even. Once it gets to 36 pip profit, we're going to move to up to 18 pips, and so on and so forth. Don't use the parabolic SAR, Ian. So we can slap it on the chart. So you could sort of say, well, so you could use it in exactly the same way, and I'm guessing is that obviously if you are there's 2 things you could do with this. You could use it in the same way that using the MACD signal line. So once you see it, let's say you're long in the trade there, once you see it sort of flip there, then you would sort of exit a trade. On a short trade, you may, as soon as you see a below price, you would actually close it again. So certainly there's merit in that. I'd be really interested if you've tested that, but just a simple strategy like that would possibly work. So let's just go back a little bit. So again, let's say we entered a short trade here. As soon as we see the dot below the line, then we could be, it could be time to exit. And so that would fit. If we're using the 10 EMA, it would be slightly, it would be a slightly worse exit. If we're using the MACD, we'll be out on that candle there. So a slightly better exit than the MACD signal line. So you just, again, you could just plant your flag. So you could take a long trade here, and you can see there, you're probably out around about the same point. So you'd be out on this candle here. If you were using that as your exit, so be out at the bottom of there. If you use a 20 EMA, probably a little lower, give a little bit more back. If you're using the SMACD, difficult to say, but probably around the same candle. Interesting, Ian. Yeah, I think that's really positive. So you're using essentially the dot on the reverse side of your trade. So if you're short, you're looking for it to be below price level. If you're long, you're looking for it to be above as your exit signal. This is the parabolic SAR, okay? So it actually puts that dot on there. I think that's a great thing to test, Ian. I'd be really interested. Drop me an email if you've been using it already, or it's just an idea at the minute. Fantastic. This is why I love these sessions. Okay. The other thing is that actually 1, 2, and 3 can be difficult if you're trading a bounce strategy. Let me just show you something. Let's find a bounce in what's bounced. That's not a great example, actually. I'm just thinking of something that's bounced. Maybe let's stick. Okay. Let's use a share CFD example for this, if you don't mind. Let's just put a MACD on this. So here's a problem if you're trading a bounce strategy. So let's say we thought this was resistance, and we're looking for a bounce off this resistance, okay? So we've seen it trade around there a couple of times, and we like this idea here. So it's a bounce and we're reversing, okay? So the reversal pattern there. At this stage, it's still showing uptrend on the MACD, although we've got decreasing momentum. So we'll be exiting if we're long this trade. It's still below the 20 EMA, okay? And really, there's no retracement to actually pin our exit on. So we could place an initial stop. Let's say place an initial stop here. So we could actually do this and say, well, look, there's our first trail, there's our second trail, and now we've got a trend pause there. We might trade it down to there at this point. So that would be one thing. But so we could use that. We could use that retracement level if it's a bounce, but we can't use the MACD because it's not. The MACD hasn't crossed that zero line yet. We can't use the 20 MA because it's still beneath that. So we've got to come up with something different if we're trading a bounce. I'd use the default setting, Stephen. Yeah, I'd use the default settings to start with anything that any new indicator that you're testing out to try. Then I would always use the default settings as the start point, because invariably those default settings come from somebody who developed the indicator or tested the indicator sufficiently for these platform developers to say, well, look, that's the default, that's the best setting, that's the setting that's been tested. So always start there and then look to amend it according to your particular trading plan. So you get what I mean? So for the bounce strategy, it might be that technical landmarks that should have really been 1 and 3, not 1 and 2. So you might not be able to use this or this in the first instance, but you could have a line that says, I'm going to use a technical landmark or an ATR level initially on a bounce strategy, whichever you plant your flag in. the fractal. Let me just show you fractals on this. Fractals are essentially pivot lows. Okay, so here are your fractals. So essentially what we might do is we might start with our stop there, and then as a way of placing it, we'd probably place it at the pivot low. Okay, so we can see the fractals there. The problem is that sometimes we get this situation here. A fractal is created by the previous and subsequent price action, and doesn't occur until at least 2 candles afterwards, and sometimes doesn't occur at all if there's a choppy movement. So at this stage, we would probably have our stop there. If we're using a retracement method, you can use there, or we can just use the pivot highs of the last time it retraced. That would be another thing, and put it on, or put it maybe 0.1 ATR or something below. Okay, so but whatever it is, you plant your flag in it and then you test the alternatives. We've talked before about how we do that, and maybe we'll revisit that again. There's a watch out for the next intermediate trading series on which is on measuring trading performance. We'll cover that in detail, which looks at not only how you journal but how you measure stuff, but also importantly how you sort of revise and review indicators that you're using at the moment to alter parameters or alter the indicators. So let's say you started off with something easy like the price crossing the 20 EMA. Ultimately, you might decide, well, look, let's try a MACD signal or a parabolic SAR. Now, position reduction, I haven't talked about this in any detail before, and the reason for that is I don't usually do it, but I know the guys from Magnetic do. Some people do very well out of it. Whenever I've used it in the past, it hasn't worked out for me, okay? So some would advocate a partial close of a position to lock in some profit. Others would suggest an exit is an exit, okay? But whatever it is, you do one thing, you get consistent in that, and then you can test the alternative. Logically, the price action that would merit this is when you've got a trend pause. Okay, so again, let me sort of explain what I mean by that. So let's say we're trading, Aussie yen at this place here. So we get an entry. So we get an entry here. Let's just change the color of that pen so you can see it on the chart. There we go. So we get an entry here. Okay, we've got a trend pause here. So let's say our initial stop was there. So what we might do is it's had a pretty good run. Okay, we might have already trailed the stop up to there. Okay, but at this point here, we've got a trend pause. Okay, so there's two things that could happen here. Go here and here. Now, with this trend pause, if we look down here, what we're seeing is we've got big volume on this candle and little volume on this candle. Okay, so that may say, well, look, this is a retracement. Then we get worried about this one here. So we say, what we're going to do is we're going to take half off. Okay, and we're going to trail our stop perhaps to here. Okay, so we take half off there, and then we leave half, and then when it's an exit somewhere up here, we'd exit the rest, probably here. In this case, we probably wouldn't have gained very much than if we'd taken the whole lot off together. Or ideally, we would have kept the whole position because it's just a trend pause, and then trailed your stop, trailed your stop, trailed your stop, trail it up to here at this point, and then everything is closed up there. So you'd obviously do better rather than taking half off here and half off there. So you've got to plant your flag in whether you're going to do position reduction, but obviously the way to test this out for yourself is to actually test it out for yourself. It may sound obvious, but really that is what people don't do. If you do that, it's going to put you in a great place going forward. So there are potential increased costs if you trade something like share CFDs to do this. So just be aware of those in your calculations. And if you're doing it already, track what happened next. So where did you exit that second half? And if you regularly, it's going to give you a better outcome than exiting half at one stage and half later. Then you know what you must do. If you're not doing it, then of course, do exactly the same. So track what would have happened at a point at which you were getting a little shaky about it. and then track where you actually got out and see if there's a difference. It's the only way to move forward as a trader and develop your individual trading style, which is going to work for you and you alone for a lifetime. Okay, so I'm not saying do it or don't do it. I'm trying to explain the parameters by which you might, or the things that may encourage you to do this. Some people would do it on, well, look, if it's gone up 3 times my initial risk, I'm taking half off, whatever. Okay. So as long as it's written down how you're doing it, then you can trade it, and then you can test alternatives later, provided, of course, you follow it religiously. That's the key thing with any of this stuff. Now, early reversal, I think I've referenced this before, but it's worthwhile just reinforcing. So despite having a trail stop in place, there's sometimes a sign that something's reversing, and usually it's subsequent to a trend pause. So, but you don't know that it's actually happened, or it may even be a reversal signal from a candle or chart pattern point of view, but still your stop's way down. So what do? Do you raise your stop, or sorry about the spelling mistake there, or do you exit early? Again, you can put something in your trading plan that says this. Now let's see if we can find an example. This might be a little trickier to find an example of this. Ooh, now then. Okay. I thought it might be tricky. Okay. Let's just put this on an hourly chart and see if we can see anything. Now let's put it on the daily chart again. Probably not the right pair to choose, but okay, let's say we're long, for some reason we're long this trade. Let's say we traded a bounce, okay? And we decide not to have a profit target. So we're trading the bounce in the fact that we bounced off a support. There's this engulfing candle, and we like this. So we trade this up, and so we entered somewhere here, and we decide that at this point here, we decide we're going to use a 20 EMA, okay? So with the 20 EMA and the MACD, we're not going to be out until this candle here. But whichever way you slice it, that's a rounded top, okay? We can see that already. We can see that that candle has been completely engulfed by that one and that one. And if you've got a bounce strategy, you've got what constitutes a trend reversal or a trend bounce. So we know at this stage that this is lower. It's lower, it's engulfed that candle and that candle. So this is on the downside, particularly as we see increased volume relating to that candle there. Okay, so this is an exit, okay, or should be an exit because it's shaping up to be a trend reversal, and that obviously happened. If we're using the MACD signal line, then we're not actually going to be out until possibly this candle here, which will be the same candle that we get out on if using the 20 EMA. So we've let go around about 53 pips on this daily chart of Aussie New Zealand, even though we saw a reversal sign there, because we've just waited until the stop was triggered. Why did that happen? Well, it happened because of this big bar here. So that took us away from our trail stop, and this is one of the reasons why we often switch to the 10 EMA. You can't go back and then go decide whether we're going to use the 20 now. But if you get a big price movement like that, usually in excess of 1 or 2, or so 1.5 risk, or 2 times risk, then we may switch to the 10 EMA here. But even on that one, it would still be leaving on the table somewhere in the region of 30 pips. We don't want that, do we? Okay, so that's what potentially we can do, is if we see a reversal, then we're out. So you can have that. If you like that as an idea, write it in your plan, but you've got to define what you mean by an early reversal, because of course we want consistency in action. So you may need to make a decision on what the anatomy looks like. So you might use a completed reversal chart pattern or candle action. So you may say 3 candles, you might say three negative candles, which take it below the last positive candle, or vice versa if you're trading short. Does that make sense? So It's something to have a look at. Now, the best way to tell whether this might work for you is to look back at the previous trades you've taken, providing, of course, you've adhered to the exit that you're supposed to. So your exit process is obvious. Check the candle, check the chart at the end of each candle. Is your stop loss or trail stop triggered? Your profit target triggered? If not, you trail again. It's really that easy. Ultimate exit trap, just to talk about some of the psychology. We've sort of answered a few questions along the way, so I don't mind it deviating a little bit from the original plan. But avoid this at all costs. Note, a signal to exit is not necessarily a signal to enter in the opposite direction. This is what happens when people get emotionally charged and start, and generally it's what it's meant by revenge trading. This is what they do. So they see something that happens, they can't bear the pain anymore. They see a couple of candles going in the opposite direction, they write them in. Okay, hugely dangerous to capital. And so if you find yourself actually starting to consider this, walk away from the markets, go and have some chill time and come back and check it out. Apart from that, so that's the ultimate exit strategy. That's the ultimate, there we go, I knew there was two. That's the ultimate sin in terms of exits, apart from not adhering to them at all. But if we look at other 4 potential scenarios, there's generally 2 healthy and 2 unhealthy exits. So a healthy exit would be exiting when a signal is presented, so the correct time when you get out, or a correct rejection, that's staying in when there's no signal. So consequently, your unhealthy exits are exiting when there's no signal, so an early exit. So you just get a little panicky or go down to a shorter time frame, think, right, I'm out of there, or you miss, you stay in when an exit signal has been prevented. So obviously what we need to focus on, because these are the 2 unhealthy ones, and these are the things that we see time and time again. I'm just answering a few questions. They missed along the way. Attila, test it. Test it out, Attila. If half of your overall position is generally what people do. Yeah, I think that's it. That's the only one I haven't answered. So apologies for missing that one before. Okay, so let's focus on these 2 a little for the next sort of few minutes. So if we're avoiding the early exit, i.e. exiting when we shouldn't, we more commonly see that when somebody's in profit and we just get a little flappy about losing the profit we've got, and we see that we close the trade down prematurely when there's no signal, only to see it move high. Now, this is different to setting a profit target, okay? There's nothing wrong without a profit target and a trail stop. But we rather exit from a trade where there's no signal. So we've set a profit target based on where we think something may pause. And that's quite important in terms of differentiating between the 2. So that's often we get this associated with loss aversion. So we're scared of losing the profit we've already got, or a preventative bias. And usually when you boil it down to it, people get a little anxiety because they've not got confidence in the self or the system. Other times where this may occur is often it can follow a series of losses. So driven by a feel of losing profit again. So sometimes it's good for the soul. If you've had like 4 or 5 losses, it's good for the soul if something goes into profit, just to rip it off. Just take it, say, helps you take that deep breath, says, I'm okay, and then go forward. So sometimes if you're really struggling, sometimes that's okay to do, but just recognize that you're probably going to leave some on the table. The other thing is, it may be that your initial or your trail stop is just way too tight when there's no reason to do so. And this takes us back to right at the start when talking about stop losses and say, well, look, you need to make sure you put your stop loss at the right place. It could be also that your dollar, you set a stop and you've made a mistake in terms of your position size you've entered. So really, you've entered too big a position, and you see the dollar lost, and you think, oh my lord, that's just not good. And so ultimately, if you ever make a mistake, you've got a choice. Do I live with that mistake and trade what I would normally trade, which could end up being okay, and I trade my system, or do I move away from the system and just close the thing down and start again? your call as to what you do, but perhaps referencing that as your trading plan is a good idea. If we have an exit miss, it usually means that we've exited late, not early. If we're looking at the downside, it's usually because we generally have a problem with feeling as though we've failed or got it wrong. And so we sort of talk ourselves to stay into the trade by looking at longer time frames, or let's just give it another candle, or all of these bargaining things. If I can just get back to break even, or if there's a signal, or I'm sure I'm seeing a signal there. If we look at the 4-hourly chart, I'm sure there's a signal there that says I should stay in. I'll just wait one more candle, and then the Jackass series, one of the Jackass series of trading, it's not a loss until you take it. And then you bargain in a reset. So, okay, I've lost $100 now. If it goes down to 150, I'm out, okay? So all that sort of stuff may be the case. In a profit situation, it may be a fear of missing out that prevents exit. So you get a clear exit signal, it's triggered your trail stop, and again, you're sort of using exactly the same bargaining stuff. Or let's just see if it goes a little higher again, just because you're scared of missing out. No, and this is why having trend continuation strategy is a good thing. This is why after you've been triggered, a profit target has been triggered because it's near a resistance level, you check back in that on that trade in a couple of hours time and say, well, look, has it actually broken through that, and is it a new trade opportunity? So if you put the right things in place, you're gonna automatically avoid some of these situations where it messes with your head and you don't follow through on what you're supposed to be doing. Now, these are big deals to overcome. In some cases, it's going to take a little bit of work to make it happen, and probably exits. If I look at the sort of one-on-one coaching I do, probably exits are where I would spend most of the attention, because that's really where people struggle. Anybody can click a button to get in, but it's what happens next that counts, as we said right at the very start. Okay, so your actions: really plant your flag in all aspects of your exit strategy. Remember, unambiguity is critical for consistency and measurement. So if you're feeling quite comfortable about your plan, maybe a couple of things there you can grab and add or consider adding. Just double check on all your statements, make sure that you can follow them. There's absolutely no ambiguity there at all. And of course, follow through and measure. Set a date for review if ever you change anything. So I'm going to review this in a month's time, or the next 10 trades, even better. It's better to do it on a number of trades, because obviously people trade different frequencies. So if you'd say, right, I'm going to trade after the next 20 trades, I'm going to review this and see if this new parameter I've put in is serving me any better or not, or this new position sizing strategy which matches position sizing to market conditions is working or not, or my new trail stop strategy using the MACD that I put in place to replace the price cross and the EMA. How's that working for me now? So make sure that if you change anything or you tighten anything off your exits, you obviously measure it, record it, and go back and check in on it later. That's all important. Okay, so let's, I think that's it. I think we've just covered everything we're going to. So we'll just have a quick check in on the market, shall we? Just check what things are doing. Well, we were having a look at what we were having a look at. We were having a look at the New Zealand yen. So let's check in on that again, see how we're doing. We're looking at 30-minute chart. So it's not quite broken through that level that we liked, that half an ATR that we liked. And look, this is why we do that, because this is sometimes what happens. Okay, if we look at our Aussie yen, we're looking at a short on the same time frame. Maybe we weren't. GB pound yen, I think it was. GB pound Aussie. Rod, fantastic, great. I'm planning to take profits as well as seeing more great stuff, Ross. Richard, can you drop me a line just to remind me to do that? Euro USD. You're welcome, Dave. Yeah. Up, down, up, down, up, down, up, down. No convincing break at all. If we look at our 80-hour, we're at 8.5 pips. Really tight time frame. Reduce that. As our level. 8.5 pips below that. So 122. 122.32 is what we're looking for on that, on the 30-minute chart. Okay, guys. Well, look, thank you very much for your feedback. Awesome participation. Good to hear, Stephen. Great stuff. I'll follow that up for you. Ewan, you're so welcome. I trust you've got something from that to apply. Of course, what I want you to do, guys, is every time you, yeah, as I said, I completely understand everybody's in that place where they're finding it a little more difficult. Josh, you're welcome. Great to see you here. Rachel, you're so welcome as always. Okay, guys, well, look, trade safe. I might see some of you on tomorrow morning session tomorrow morning session in the morning. Of course, we've got the CFD session, which you've got the link for in the evening. So I'll look forward to seeing you either of those. In the meantime, take care of yourselves, trade safe, and we'll catch you again very soon. Fantastic to hear, David. Thanks for the feedback, mate. That's awesome. Enjoy your evening. Bye-bye for now.